Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Dan Boyd, senior energy analyst with Mizuho Americas, having recently just launched coverage in the energy space. Dan, congratulations on the launch and welcome to Trade Talks.
Thanks, Jill. Thanks for having me.
Yeah, it's good to talk about some good old sell side research these days. And let's start with your overall thesis on the space. It's an interesting one to be in with alternative energy, EVs, the Green New Deal, front and center with investors.
Yeah, absolutely. You know, the title of our report is Oil Strikes Back. And part of that just comes down to the overall theme of alternatives. And that is creating this fear of peak demand. But peak demand is still at least 10 years away based on our analysis. But in the meantime, that's having a very real effect on current supply. Because you're telling every oil producer in the world, hey, we're not going to need what you produce 10, 20, 30 years from today. And so they're no longer exploring at the same rate they were previously, and they're cutting back. And many of them, you can see it in Europe, most evident with BP, they're pivoting to renewables, right? BP is going to increase their renewable spend up to 10x previously. They've pretty much gutted their exploration team, and they're telling you that we're going to produce 40% less oil by 2030. In the US, on the other hand, you have companies that have historically been not very disciplined, have grown significantly, and they are now returning or going to a cash return and returns-focused business model. And that's going to limit supply in the near term and over the long run. At the same time, everything that the Biden administration is doing so far is also restricting supply. So we feel very good from an oil price standpoint of what oil prices are destined to higher over the next 5 to 10 years.
You mentioned that fear of demand loss is leading to the actual loss of supply. When do you expect this to fall back in balance?
Well, as of today, we are in an undersupplied market. Inventories are drawing, they're declining from abnormal levels. Now that's supported by OPEC and what we call OPEC plus, their friends, including Russia, which have pulled production off the market. So we look for a more balanced market in 2022, where OPEC production is going to have to come back. And actually at that point, we think you're going to need the US shale market to start growing again. The real imbalance comes in a 2025 post period as the underinvestment today really starts to manifest itself in lower supply.
And Dan, what's the risk to this thesis?
Well, you know, when you're predicting oil prices, there are always many risks to the upside and to the downside. I think in the near term, as I look at it, the biggest to oil markets is what does the Biden administration do with Iran? Iran has 1.5 to 1.8 million barrels a day that could come back onto the market, and that could absolutely spoil things. The other side, if I look over the next 2 years, it's what are the US E&Ps going to do? Are they going to remain disciplined and return cash to shareholders, or are they going to go back to their old ways and grow for growth's sake?
And to wrap up here, what are your top picks?
So I put our top pick into 3 different buckets: safe, a little more risk, and then riskier. So on the safe side, I think Chevron really stands out. They have a 5% dividend yield. They're the epitome of capital discipline. They have a concentrated portfolio of core assets, but they also have some global diversification as well. The next pick would be Conoco, where we think you get the best of both worlds, where you get E&P type leverage, but capital discipline of a major. And then on the riskier or the higher beta side, I would put Occidental Petroleum. Highly levered balance sheet, but they have very good assets. And they have a new business that's emerging on the carbon capture side, which we actually have valued at $2 to $5 billion or $2 to $5 a share. And that's substantial, a $2 stock that we think is receiving no value in the stock today. And quite frankly, there's upside to the business. So they're not only levered to oil, but they're also a solution to the carbon problem that the world has.
Dan, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.
Thank you.